People who invest do interesting things.
Here's why LEGO Star Wars sets are actually an investment.
Tell me a quick way to make $10,000 a month.
Something that's big is the watch market right now.
We got yet again another 3 cryptos that are going to 100x by 2024. An AI project known as Aura Chain.
If we want to understand financial markets, we need to develop a general theory on how investors decide. And in academic finance, there are just 3 criteria which investors base their decisions on. It's presence preference, more is better, and risk aversion. So let's get into them. Our first one is presence preference. I like to have money sooner than later. If you had the choice, I give you 20 euros today or in a year, what would you choose? Well, obviously today, right? And this is the secret to presence preference. Let me show you how that works out in practice. This graph is called a yield curve. What it shows you is, it shows you the return on bonds issued by the US government. That means it's a contract where you pay the US government now and they repay you later. And on the x-axis, you see the time of repayment. It goes up to 30 years. And on the y-axis, you see the annual return on that bond. So for instance, the 1-year bond is, I give $1 to the government, and in a year, I get that $1 back plus the interest rate. For the 30-year bond, it works like this. You give, for instance, $1 to the US government now, and they repay you in 30 years. And they repay you that $1 times the interest rate, which is 3.2%. And that interest rate is the annual interest rate. So we need to take that to the power of 30, as that annual interest rate is paid for 30 years. So on that 30-year bond, you get $2.6 back after 30 years. And if you look at that graph, you notice something. The interest rates are higher if the repayment is later. And that is just presence preference. People like to be paid sooner than later. And if you want to pay them later, you need to compensate them. You need to compensate people for waiting. And that's why longer term bonds have higher annual returns. Our second investor trade is more is better. And that is pretty obvious. Let's say Facebook issues 2 bonds. In bond 1, you need to pay $1 today and you get $2 back in a year. In bond 2, you need to pay $1 today and you get $3 back in a year. Which one would you choose? All things being equal, people just like more money. No one would buy stock 2. And a third trade is risk aversion, or we could also call this uncertainty aversion. Let's look at this graph. It shows you 2 stocks. If you had to invest in one, which of those stocks would you choose? Most people would choose stock 2. Why? Well, first, both stocks have the same return of that year. They start at 1 and they end at roughly 2. So with both stocks, you would make a return of 2 over 1, which is 200%. But stock 2 is way more predictable. It does not jump around that much. And that is what is meant by risk. How predictable is the value of an asset? And it just turns out that as a behavioral trade, we hate not being able to predict what's going to come. And from my personal experience, the time when I felt most stressed was the time when I had big uncertainty in my life. For instance, after my undergrad, I went on the job market and looked for a job. And that was super stressful because I didn't know what was going to come and if that job was going to be good. And I was asking myself, why am I so stressed? And then I was reminded of what my finance professor told me. You don't like uncertainty, and uncertainty causes stress. The question now is, how do we measure uncertainty? And the most common measure of uncertainty in finance is volatility. Let us calculate volatility for stock number 2. If we want to obtain volatility, we first calculate the overall average stock value, which is about 1.5 for stock 2. And then we calculate the average distance of every single point to that overarching average. Volatility is the average distance of every single data point to their overarching average. So if we calculate that for both stocks, we get 0.29 for stock number 2 and 0.35 for stock number 1. That's just the numbers which you see from the graph. Stock number 1 moves a lot more around than stock number 2. But there's one big problem with volatility. Let's look at this graph for stock 1 and stock 2. I manipulated one thing. At day 100, stock number 2 drops to the value of 0.2. And from an investor's point of view, that event is very bad. Let's just imagine you've invested in that stock and you want to buy a house. And then the day comes, you want to buy that house and you see that your stock just crashed in value and you can't afford the house anymore. So you do want to avoid those stocks which have rare but very bad events. And volatility does not really pick that up. Why? Because we calculate the average distance of every single data point to the overarching average. And since we have 365 data points, one single data point doesn't really matter for the total volatility. Let me give you the numbers. For the unmanipulated time series, volatility is 0.290. And for the manipulated time series, volatility is 0.298. In other words, there's not a lot of difference. And that is why finance people started to look for other measures of volatility. This discussion gained a lot of traction after the financial crisis, because the financial crisis in 2008 was one of those rare but very bad events. A lot of assets lost a lot of value in a very short time. One of those measures that looks at rare events is the value at risk. It's a worst case measure. And typically in finance, the value at risk is the worst case in 1,000 cases. For math people, it's a 99.9% quantile. Let me show you what that means. I once again have stock number 1 and stock number 2, but now it's not 1 year, but it's 1,000 days. And our value at risk is just the smallest stock value over this entire period. So for stock number 1, it's 0.6, and for stock number 2, it's very close to 1. But once again, let's look at the manipulated time series. For stock number 2, the lowest value is now 0.2. So you see, huge difference. Value at risk before, 1. Value at risk after, 0.2. So what people in the industry now do is they look at multiple measures of risk. They look at volatility, they also look at value at risk, and there are also other ways to look at risk. But volatility alone is not enough, because volatility alone does not tell you a lot about those rare but very bad events. And this is an insight one guy, Nassim Taleb, made his entire career about. I think he wrote 3 books on that. I mean, other people only take a few sentences, but anyway. Putting everything together, we can actually now develop a math formula that tells us how much an investor likes an asset. And here it is. 1 over the time horizon factor times average return, that's the return of the asset, minus risk aversion factor times volatility. Let's go over that formula. The higher the return of an asset, the more our investor likes that asset. Kind of obvious. The higher the volatility of that asset, the less our investor likes that asset, because there's a minus in front of the volatility. But you see, there's this risk aversion factor. And this risk aversion factor reflects that people have different risk aversions. In other words, some people dislike uncertainty and other people dislike uncertainty a lot. You can think of very conservative people like Joe Biden having very high risk aversion, and very crazy people like maybe Kanye West having very low risk aversion. And then there's the time horizon factor. And this factor reflects when the asset repays. The investor likes the asset more if the asset repays sooner than later. Let me just calculate our measure of how an investor likes an asset for our stocks 1 and 2. Both stocks have the same return, it's 200%. Let's say we want to sell the bond after the first year, so the time horizon is 1 year. So what is the time discount factor? Well, we can just take the interest rate for US government bonds. Looking at the data, the return on a 1-year bond is about 2%, and that is our time horizon factor. In economic theory, this is called the discount factor. It tells us how much money is worth now compared to money that you get in a year. For risk aversion, there are actually a lot of surveys where you can look at your own risk aversion, but people are usually between 1 and 10. So let's just take 5 as a risk aversion for our investor. And then I plug in the volatility for both stocks. And the result is the number for stock 2 is higher than for stock 1. Our investor likes stock 2 more than stock 1. Why? Because stock 2 is less risky, and we measured that risk using volatility. But let me clarify. This is a model which we will use in the course to understand how investors behave. But you already know one reason why it's imperfect. For the reason that volatility is not a perfect measure of risk. So in advanced finance courses, you will find other measures of risk, and they will change this model. But for an introductory course, this will give us very good intuition into what's going on. And this is it. This is how finance people think about investors. They have presence preference, more is better, and risk aversion. And in the end, I gave you a simple formula on how to calculate how much an investor likes or dislikes an asset. People often criticize these assumptions. They say, this does not hold true for everybody. I mean, people go to Las Vegas and play with their entire money, right? So it cannot be that everybody is risk averse. What you're doing here is just not true. And to that, I have two responses. First, we're talking about human behavior here. Making a statement, people are risk averse, is like making a statement, people like sugar. Well, obviously, there are a couple of weirdos out there who do not like sugar, but the overall majority does not act that way. And second, on financial markets, remember who makes the big decisions. It's not the guys that I showed you in the beginning of the video, the guys who do the crazy stuff. No, it's the big institutional investors like banks or pension funds. They have the big money and they act rationally in accordance to those character traits. I will actually show you later in the course that there's laws requiring banks to be risk averse. So those three character traits are actually a very solid foundation if we want to understand what's going on in the financial market. So now, as we've understood how investors make decisions, we're going to try to understand how they actually pick assets and select their portfolios.